I'm amazed that we're still seeing assets rallying to the extent that they're rallying when this is what the market was expecting.
Well, I think it was marginally better in terms of the quantum, but not as good in terms of the tenor of assets they're going to be purchasing. But I think that they clearly couldn't disappoint. And I think what we had seen is people forecasting sort of 2 trillion in terms of purchases, coming way back to 500 billion, and then obviously delivering a 600 billion number thereafter. So it was bound to, they'd already gone too far and then been pulled back too far. So I think it was actually a little bit of a positive. The dollar obviously sold off quite aggressively, and that's helped commodities, as well as obviously the inflation, presumed inflation connotations of this quantitative easing has boosted commodities, particularly gold. So overall, I think the scenario is pretty much as what we expected it to be.
And Wayne, are you surprised at this positive momentum post the announcement?
No, look, I suppose, I'm surprised to that extent, because I thought they won't disappoint the market, but I also thought by and large it was priced in.
Into the market.
But understand what it means is that for the next, I don't know, 6 months, year, who knows, but for the next while, money is cheap and there's lots of it, and developed markets are in trouble and emerging markets are growing. So what we've seen post the double dip scare, which no one even talks about anymore, post the double dip scare. So in other words, let's say beginning of September.
Steve may still talk about the double dip scenario.
Now, I think a double dip's coming. I just think it's going to be a nice couple of years between the two. But besides that, let's say beginning of September, what we've seen beginning of September to today, we're probably going to see for the next 3 months. The markets are going to be going up.
You were relatively bearish a while ago. Do you still hold a bearish stance on markets generally?
I think in terms of in the short term, I think this quantitative easing is very positive for market sentiment, and we've seen that. And as long as data doesn't disappoint, and maybe we're getting a little bit better.
Well, the jobs data came out incredibly high today.
So I mean that's obviously going to further ambitions in stock markets and commodities as well, as people say, okay, we've got quantitative easing, great, we've got growth, great, everything looks pretty rosy. We're still forecasting growth of a meagre 1% in the States next year, and that still matters. I think if we get a double dip, i.e. negative growth in the States and in Europe, etc., in 3 or 4 years' time, it matters a lot less than it matters today. We are in a structural change of growth patterns around the world. The US is still going to need to deleverage. I hope that comes through inflation. Not through people stopping spending. I think that's the least painful way of doing this. But I think that overall, China, India, Korea, Africa, and the Middle East are all growing at very strong paces of growth. And that, over time, will mitigate any negative implications from the West. We're just buying time, to be honest.
Your strategy right now, with 32,000, we're very close to that level.
There's no value in our market. I mean, understand. I wouldn't say it's overvalued.
But what about the resource stocks? Something like Anglo American?
Oh no, they can run like crazy. It doesn't mean that they value. Okay, I mean if you look at what Billiton's done literally in the last couple of weeks, I mean this thing has shot up hugely. So their forward PE is probably in the region of 13, 14. So they're not overvalued. But understand there's no value out there. However, is the market going up? The answer probably is yes, and it'll just go up on the back of all of this free money. And I agree totally. I think inflation's coming back into the system. There's not a single sign of it or a whiff of it at the moment. But I think on a 5-year horizon, it is the only way the US can solve its problem, is to have a little bit of inflation. And they're sure enough printing enough money to cause future inflation. That's why I'm very positive on the gold price on a 3 to 5 year term. I think it's run too much in the shorter term, but on the inflation outlook long term, very, very positive.
Now, Nouriel Roubini made the statement that gold is rallying not because of inflation fears down the line, but rather because of a potential financial crisis down the line, another financial crisis.
Well, I suppose, I think it's actually part of the same factor, because if you're printing lots of dollars, then the dollar weakens, that could lead to a crisis. I totally agree with Wayne's point earlier on the treasury market. I mean, if you're taking a long-term view, would you be investing at treasury yields where they sit today? I think the answer is incredibly no. So you've got a lot of potential, and I think actually that is probably the next bubble. It's we're talking about a stock market bubble in the making. Look, and I agree, we're very early in the stages of that. We're not seeing really stretched valuations at this stage, assuming growth obviously remains in play. But the bond market valuations are extraordinarily stretched. If I was to twist my arm and say, what would you do over the next 3 months? Yeah, okay, I'd buy treasuries, 5 years and less. But if you're saying over the next 5 years, I'd short that market hugely.
Just before we let you go, copper at $12,000 a tonne. I see that's the forecast on the cards from Standard Chartered. I've been speaking to your colleagues in London, namely Tom Cochiel and Daniel. In terms of that copper price, 2-3 years out, $12,000 a tonne, is it sustainable? And Tom has put on the table that it is aggressive supply side constraints that will lead it higher, and
the increased
Asian demand,
of course, yeah. Look, there will be a weaker dollar probably in there as well, but obviously the demand dynamics are very powerful the longer out you look. And you've got, in the short term, you've got the investor demand coming in. So with the ETFs. Demand we're seeing from physical ETFs, which we don't actually think makes that much sense given the storage costs. But the demand for copper from these things can make a big difference. We've already seen that the copper price can go from 3,200 to 8,000 in the blink of an eye. So we're only, it can do it very quickly either way, of course. So will it be a smooth road to 12,000? Undoubtedly, that will not be the case. But we're only looking for a 50% increase. That could happen in 6 months, let alone 3 years.
Steve, thanks so much for joining us. Steve Brice from Standard Chartered. Wayne, we need to talk about BHP Billiton, and yesterday the Canadian government is saying no to the $39 billion on the table for potash. BHP rallied hard yesterday, up 6%. I'm just looking today, we're up 0.5%, 269 Rand on BHP Billiton. They have got 30 days to respond. Do you think Marius Kloppers is going to go hard on this, put another offer on the table?
I think they're going to stand down now. When you get rebuked like that. But I mean, who knows? I think it's wrong for the shareholders to be happy the deal's off, because I think if there's one area, in my view, a true structural thing, it's food over the next 10, 20 years. The demand for food, I think, is going to be enormous, and the demand for protein in particular is going to be enormous. So I think you've got to get into agriculture, very, very longer term, not in the next week, but very longer term. So, but the market's certainly like that. I mean, to see a 600 billion rand market cap company go up 6% in a day, it's highly unusual, quite frankly.
Old Mutual out with third quarter results yesterday, and we saw a flat life sales. We saw unit trust sales up 36%, and also Julian Roberts commenting on the shock and horror over HSBC walking away from Nedbank.
No, but there would be, obviously. I mean, HSBC, and I mean, I'm not the first to say this by a long margin, they can walk away whenever they want to, they're entitled to. But I think we, South Africa, Nedbank, Old Mutual, the Reserve Bank, deserve an explanation as to why. And I think eventually we will get it, by the way.
But why aren't they forthcoming? I can't understand why. I mean,
look, in my books, and I mean, I know nothing, this is pure speculation. I mean, Julian Roberts doesn't know why, so I mean, my speculation, I personally think, I don't think anything scared them at Nedbank, by the way.
Oh, do you not? Because I thought that's where you were going now.
No, not at all. I think they've got some other big deal lined up that's bigger than this one, and they couldn't do both of them. But they not quite able to announce whatever the other deal is. But that's
so you don't think it's got anything to do with something wrong at Nedbank, at the Nedbank stable?
We would have sniffed that out already. The industry, the market, would have. If something was really rotten there, market would know about it.
Goldfields also came out with a first quarter trading update yesterday, and there we had headline earnings per share down 1/3%. But the company is making the right moves in a very tough environment. Deep level mining environment in South Africa in the gold front.
Deep level mining environment in South Africa with the electricity costs, the labor costs, but probably right at the moment the most important, the strong rand. This is an incredibly difficult scenario. Gold shares rallied strongly today. I think they're the biggest rise on the index, about 2.5%.
Harmony is up 5%. Goldfields is up 4.5%.
Strongly
Anglo Gold 2 1/3. But we've got gold just below $1,400 an ounce.
The problem is the rand's killing it, man. And it's to these people, all that matters is the rand price.
But I thought in rand terms, the gold price is not that far off its all-time high.
It's not that far off, but when you've got the rand at 675, it takes away the odd $30 rise in the gold price rapidly, and the rand's been very, very strong. And it touched 7 week or two ago. It's right back down. Now, and as we saw the reserves today, the Reserve Bank is staying, you know, the chaps are working at their desks till midnight trying to buy dollars in the market and sell rands. When you look at our reserves, how they've shot up. Okay, a lot of it's the data deal, but it doesn't matter what it is. They still neutralized big inflows into here, and it costs money eventually. So, yeah, I still don't like gold shares, simply because for South African gold shares, I think the costs will, it is so difficult to get a good return out of the mines.